Hello and welcome back to Retire with Oakleaf. My name is Vasilis, or Just V, and I'm sitting here with our founder and investment manager, John Street. John, today I would like to converse with you about a very popular topic, and that is none other than diversification in investment. So, John, just to start building the foundation, what does diversification mean to you?
Well, in as far as portfolio construction and a client's overall financial goals, it is what it really means to me is building in safety of some sort, building in to one's portfolio a robust ability to withstand difficult times. You know, diversification in this world right now of AI, where things are skyrocketing. At times, you know, a widely diversified portfolio may not seem all that, sexy or timely, but in the long run, it's one of the most important themes that we stress with clients. There's many different ways to diversify. You can diversify among regions. You can diversify among industries. You can diversify among types of companies, large and small, mid-size. You can diversify to companies that pay a dividend, that don't pay a dividend. You can diversify by asset class, meaning companies that work with hard commodities like miners and gold companies, which we own right now, and energy companies. Agricultural companies tend to do better, not all the time, but they tend to do better at different times than your tech companies. Real estate is obviously another diversifying factor. If you look historically, when we go into a very difficult time like recession, we tend to have a lot of things go down. Everything tends to go down, but some of these things tend to go down much less than others. And as financial advisors, that's much more our concern than making sure we kind of pile everything on the chip, at the roulette table that we think is going to do well. We're tasked with making sure people get from point A to point B. So that might have been a longer explanation than
That's
you were
great.
looking for, V.
No.
But there's a lot of different ways to diversify, but it is key to the way we view portfolio construction.
That's great. So next question to build up on this answer would be, hypothetically speaking, client comes in with $2 million in an IRA. How do we start thinking about constructing that specific portfolio? Do we put everything in one strategy, in one allocation? How do you typically advise clients on this?
So I'm usually last on that list. I follow you and the financial planning team. So what we really want the client to understand is what their financial planning future looks like. In other words, what do they think they wanted as a retirement income or for a goal, whatever they come to us for, what is their want? And our job is to kind of give them some perspective in regards to where they are in regards to that need. And that involves a lot of planning techniques that come before, the investments, meaning, the bucket approach. How much do we have in cash and safe investments for emergencies? What about, that interim period from year 5 to 11, where we want it to be growth oriented, but not wildly volatile. And then we have, really the growth bucket, 10 years and longer. And so I take my cues from the financial planning team that tells me, here's what a client needs. We have modeled it out. We have looked at, higher than normal inflation in this model to be conservative, lower than normal returns from the market and investments, because we want to make sure that people get from point A to point B. Once you have done that, and we have what we feel is a conservative estimate of what a client can spend, then I get to have some fun and talk with clients about how much in specific investment classes that meet that broad-based financial plan. And I think also very important in that is helping educate clients as to what kind of risk reward are they comfortable with. It's key in my position to understand that clients are long-term, that they understand what nobody can predict absolutely where market's going to go, but we can look at history and we can say, over a 10-year period, a 20-year period, here are likely outcomes. Is that comfortable? Can you move through a period like that to enjoy the benefits of long-term investments? Or do we need to scale that back? That might be uncomfortable. That type of volatility might be uncomfortable. And you're willing to have a little bit less money in 10 years for the offset of having a portfolio that you can live with and doesn't drive you nuts over a 10-year time frame. It's all a series of decisions that we try to help our clients understand. We are trying not to make those decisions for clients. We're trying to educate our clients and help them make the right decisions.
That's a good response. John, given your vast experience in managing client assets over the years, how has diversification and portfolio construction changed in your eyes and your experience?
Yes, I'm an old guy. V, great question. I would say that the industry for me has moved in kind of amazing ways, especially in the last maybe 15 years, because I would call it kind of the democratization of assets. And I think there's further to go. There's more information about, for a portfolio manager, there's more information and sources on everything under the sun investment related that one could think of, which is really wonderful. That was 20 years ago, that was segmented to a couple of large firms, and everybody was always leaning in to hear what they thought. And now there's a plethora of great managers that give their thoughts on different themes, which is super helpful. I think one way that has changed portfolio management for me is back to our discussion of diversification. You can diversify among all the things we talked about, asset classes, regions, countries, whatnot. But I like to diversify among managers. I generally recommend to clients that we have no less than 3 different management teams running money. We can be one of those if a client wants us to run their money, but I don't want to be the only one running their money. There are a lot of talented portfolio managers. I kind of look at a lot of the asset management companies as kind of baseball teams. One team has great pitching that, they do fixed investments really well. They're really good with interest rates. Another team has great fielding, or great batting. They're great with growth stocks. And so being able to diversify in that way, I think is super important, because there are managers, in 40 years, I can pretty much think of 10 different companies that at one point were the go-to best companies you could go to, right? Everybody knew that company because they were just crushing it. And then all of a sudden they fell off because the theme changed and another management team was kind of early on that. So just another way that diversification is important in one's portfolio management strategies.
And it all ties back to the financial plan. Like you said earlier, you take the cues and the results that are coming from the completion of a financial plan for clients. That goes without saying. Otherwise, if you don't have a roadmap of where you're headed, how do you know what direction to take and how to adjust the sales along the way?
Client needs come in lots of different flavors. We have a vast majority of our clients that have specific goals, and that's our task, is to kind of, when we meet with them, focus them in on where are we going. Just like a business plan. How have we done last year? Are we on track for that? Do we need to change something? Can we fix a tax issue? Can we take some gains? Has it been a difficult year? We need to make sure that we're taking losses. But there are also clients that we have that are doing very well, and they have their goals more of a overall portfolio view. Like, how are we doing from a portfolio view? And they know they're going to be fine during their retirement or achieving their educational goals. And they want to make sure that they've dialed in the right amount of risk return. They don't want to be surprised. Nobody can guarantee anything in the investment world, but you can use a lot of statistics to kind of show clients, roughly speaking, here are some parameters that we we think are probably going to hold. No guarantees. And that's another area that our industry has really excelled on. Computers, analytics, algorithms have really given us the ability to kind of go back and slice and dice history from probability point of view, with the understanding that you need that financial plan, you need that bucket, because that might be wrong. Statistics are great, but when they don't work, you need a plan in place.
So this is a little bit about how we view diversification, how we utilize it in our financial planning and our investment management, and we will talk to you soon.